the founding director from the Center on Global Energy Policy from Columbia University, joins us for this session. Please welcome Jason Bordoff. We're absolutely delighted to have him here. From Warburg Pincus, the Senior Vice President, Political Risk and Public Policy, Environmental, Social and Governance, John Feiner is with us. John, thank you so much for being with us. We're absolutely delighted to have you. From S&P Global Platts, we're delighted to have the Head of Analytics, Chris Midgley. Thank you, Chris. Okay. We're also joined by the Managing Director and Portfolio Manager for Real Assets from PIMCO, Greg Shernow is in the house. Great to see you, Greg. Thank you so much.
Yeah, cool.
And from Invesco Company, the Senior Director of Global ETF Strategy and Research, Jason Bloom. So what a lineup we have got here. There's not a question these gentlemen can't answer. If one of them can't, I know they'll move it on to their colleagues very quickly here. We're absolutely delighted to have all of your focus, your attention, your energy, your expertise, all of that to share with us here, because I think this is probably one of the most important topics, of our time when it comes to the oil and gas sector. And I think we've heard this, maybe not very blatantly throughout, but it's all been there in almost every session we've talked about too. It's about perception. It's about, are we doing the right thing? And I think the industry has a lot more to do. And I think that we will look at that. But Chris Midgley, let me start with you. When you look at, first of all, upstream, and you look at, the oil and gas sector, what do you want to, what should we be looking at in this, whole sector? Oil, gas, bring me all the bits together, bring those parts together for me.
Yeah, I think you use the word perception. I think we've had a lot of conversations over the last day and a half where we've said coal is evil and gas is a good replacement to it, and oil well sits somewhere in between. But the reality when you're thinking about ESG, which we'll talk about a bit more in detail, is how do you measure and compare the relative carbon intensity of the production of any of those? So coal is not necessarily bad if you are the most efficient producer of that coal with the lowest carbon intensity, putting it into a power plant which has got CCS. That can have a very strong scoring. Oil, we like to criticize oil sands, but a lot of the energy is in putting the mine together, the water systems, but actually the marginal production can have relatively low energy intensity. So I think what we really need to do is we need to move this to facts, and I think that's what ESG is trying to do. It's trying to score that. And in S&P Global Platts, we've got True Cost, which is intended to try to measure the relative intensity, carbon intensity of businesses in order to score them correctly, and then allow the market to drive the right outcome to the lowest carbon impact that the total upstream business can have.
Yeah, I think you're reflecting, I think was it what Fatih Birol said too, that carbon is not all bad, it's how it's managed and how important that the industry, the importance that it gives and how they do it. It's about doing it right.
Indeed, it is about doing it right. And I think, again, don't want to pick on gas necessarily, but, we talk about gas being lower carbon, and yet, for those who are reading the news will have seen in Ohio, Exxon had a blowout of one of their gas fields, just one gas field in Ohio, which emitted 60 kilotons of methane. That's the equivalent of a year's methane emissions from the UK or France. So it doesn't come without risk, and we have to measure that, and we have to compare that when we're rating and understanding the total environmental impact of the operations.
Now, Greg, we've been looking at ESG considerations for quite a while. I mean, we've had this conversation time and time again. But when we're looking at investor awareness and looking at these concerns, where's the implication on capital allocation? Because ultimately, it's almost the trade-off it's becoming at the moment. If you don't get it right, you're not going to get the money in.
Yeah, I think it's the change in the energy space. When I think about it from investor, energy and environment have always been interrelated. Whether it be the IMO change in fuel standards that we have right now, whether it be emission standards, renewable fuel standards, and so forth. Environment has always played a big component in the policy and some of the market capital allocations. What's changed, I feel like, in the last 12 to 18 months is how aware investors are to ESG issues. And I think the G really sort of, and the governance issue that a lot of E&P companies had challenged in the United States, and a lot of the capital that's been destroyed has helped sharpen intentions. But as the global movement to climate awareness has accelerated, it has brought it all together into one piece where I don't have any conversation with any limited partners at PIMCO where this isn't one of the first questions asked. And when we think about approaching or being approached by investors, it's amazing how many times people won't even look at upstream E&P anymore, when in the past they would have. So now they're thinking about how can I create a portfolio that has maybe the hedging characteristics I want for inflation that doesn't have an E&P. And they're creating little carve-outs. It's like, oh, well, maybe midstream's okay. Give it 12 or 18 months, there'll be questions there also. And I think that creates a tremendous question about how the oil and gas upstream space is going to finance itself over the next 5 or 10 years, because investors are moving in the opposite direction and at a much faster pace than I thought possible even 12 or 18 months ago.
John Feiner, when you look at your role and the pressure that private equity investors are under at the moment, has that increased? Have they really been? Are they being pushed now to actually take action on ESG?
So there's no doubt that pressure is greater. I think for a long time, private market investors were, relatively speaking, insulated from these sorts of pressures when compared with corporates or public market investors, in large part because they could operate below the radar, or had fewer disclosure requirements, really were only answerable to their investors who weren't really asking hard questions about this. So the way in which this has changed is that our investors in private markets are now asking significantly more questions, more sophisticated questions, more detailed questions. They're not just satisfied to hear that maybe you have an ESG policy or you have a person in your firm who's responsible for ESG. They want to know how you're measuring your success when it comes to ESG. They want to know if you're collecting data from your portfolio companies, these sorts of questions. So the questions from investors are getting harder. Second, outside groups, separate and apart from investors, are increasingly scrutinizing private market investors in the way that they have always, I think, scrutinized public market investors. Just to give one example, people should look at a December 12th, I think it was, article in the New York Times where the newspaper hired actually an airplane that had sensitive sensor technology to measure methane emissions in the Permian Basin in Texas and New Mexico, and then went around and called the companies and the investors in those companies to ask about the emissions information that they had gathered. That sort of outside kind of transparency pressure, I think, is a big change, and you're getting it from NGOs and newspapers. And then finally, regulatory pressure, I think, has kind of lagged the other two when it comes to the private markets, but you're starting now to see in the Hong Kong exchange, actually now in the European Union, regulatory pressure around ESG transparency. How private investors, even when their companies are on the public markets, are thinking about ESG integration in these companies. The U.S. is a bit behind in this way, but you're seeing
And I want to talk more about that. So hold that thought there, because I think that one's absolutely fascinating. We really need to look at it. Now, it's always good to have two Jasons on a panel, just to confuse us all. And then both of them, their names begin with B. So I'm almost Jason B1 and Jason B2. I'm going to go with Jason Bloom to start off here. And this Jason, we've got bookends for this one. Thank you, gentlemen, the way I won't mix you up here. Talk to me in terms of how important and effective we're looking at the ESG scoring by institutional investors. How actually important has that become for private equity and indeed for fixed income?
Yes, so this is something that I think it's becoming very popular. It's very new, but it is growing very rapidly. So at Invesco, just within the last year, we have implemented a robust ESG screening process across 300 billion of fixed income portfolios. Actually, it's on the equity side where you've actually seen a lot more of the conversation over the last couple of years, divesting from equity exposure, but on the fixed income side, we're implementing it. And the reason is, and I want to be very, very precise in defining how we approach ESG. Now, part of the problem is that ESG means something a little bit different to a lot of different constituencies. It is not activist investing per se. ESG rarely involves divestment from our perspective. There are very few industries that we screen out, basically tobacco and firearms. And then everyone else has a shot. Really what ESG is meant to do, and I think I would take a little bit of issue with the prior presentation. I think that description was a better description of the attitude of the retail customers, of the people to whom we're lending money. We're a very sober bunch. Return on investment is still the highest priority. But where ESG is coming in is that if a company is behaving badly and their customers perceive that, and that becomes a financial risk, that is where the ESG score begins to impact our behavior as an investor. So for us, ESG is actually not about activism, it is about measuring risk in the portfolio. And so if a company's behaving badly and that has a material risk, financial risk for them, then that their score is going to move down, right? But I think that's an important part. You know, it's not like college students are coming up to us saying, pull the plug, and we're going, maybe we should pull the plug.
Okay,
it's
a different pressure, yeah. And so it should be. Jason, when we look at the, pressure that is on, coming from society, coming from shareholders, I mean, it's there and it's very visible and it's very vocal. It's not going to go away. What can companies do? I mean, I think we're seeing some efforts been made, but there is not the big sort of silver bullet solution that says this is going to sort it and we're going to turn this around and we can have a better narrative. It's taking a while. I feel that companies are struggling.
Yeah, and partly I think it's because even in this conversation so far, we're talking about ESG meaning lots of different things. And so there's a company like Warburg and how it thinks about the oil and gas companies in its portfolio and trying to set a really high standard for the way they conduct their operations. The fugitive methane, the flaring, all of those things. And that's really important. I will say, as someone who has spent a career moving back and forth between policymaking and policy research, that's also where policy comes in, and regulation is important because you don't want things to revert to the lowest common denominator. You want to set a level playing field, and there's a lot of heterogeneity among companies. The pressure around divestment and concern with systemic risk to financial markets, that's not just from the way companies are doing their own operations. That is from pressure to pull back from investing in the sector entirely, either because people are concerned about financial risk or because they think that that will drive faster change. And I think that is a pretty complicated question. I think it also comes back to the importance of policy because right now, look, the world's chock full of hydrocarbons. There's no lack of them in the world, and the world's chock full of capital. There's a lot of capital in the world too. So when you start to see some actors pull back from investing in that sector, other capital finds its way in. Even if you had squeeze the balloon in one place and you had a little less production in the Permian, there's other places in the world that would produce, which is why the focus on policies to reduce demand in the first place is so important. And the challenge for the industry is the pressure to show that they are increasingly investing in low carbon sources of energy and diversifying their mix. But actually, if they go too far in that direction, they get penalized in their share price because they can't earn the same returns. And the world, they're evaluated on, is your investment plan consistent with 1.5 or a 2 degree scenario when almost no policymaker around the world is taking those targets seriously in the level of policy ambition that we have in place now. We are way off track to meet the kind of climate targets that we need to meet. And that is coming to a head in the difficult position that many of these companies facing this ESG pressure find themselves under.
John, if you'd come back to that issue on regulation as well, and when we look at, do companies really need to be going beyond the legal compliant mindset? I mean, where's the regulation on this? How advanced is it? Are we struggling with it? Is it happening? Is it going in the right direction? Do they know what to do?
Yeah, I think there are different phases of this process, and it actually goes for regulation. It also goes for the sorts of investor pressure that we were talking about earlier. I think the early phase, maybe 5+ years ago, nobody really asked these questions. Regulation didn't touch these questions. I think the phase we're in now is investors are at least asking the question. I think wide open whether they actually are making investment decisions based on the answers to those questions. I think in many cases these answers are not driving decisions. And now we're in a phase, a sort of middle phase, where regulation is focused on transparency, but not actually requiring action on the part of private market investors. I think a next phase, which who knows if we'll actually get there, is investors in large numbers actually driving their decision making based on these ESG factors. We definitely have not found that yet. And the next phase when it comes to regulation would be regulation actually requiring certain steps taken by private investors or the companies that they control, and we're not there yet either.
Any other comment on the regulation? Greg, do you want to come in on that, or Chris?
I think, regulation is often a very inefficient way of getting to the means, and I think the market can do this very effectively itself and is starting to do that. If you look at the ESG ratings, and we've just acquired another ESG ratings company, what that does is it increases the cost of borrowing to companies that cannot demonstrate that they have resilience against environmental, social, and governance issues. So that in itself drives up their cost of borrowing, which makes them less competitive. The new ESG indices, the S&P 500 ESG, enables investors to easily choose a set of stock which meets the highest ESG standards. And if you look at today's investors, they are much prefer to have indice-type based stock. And we're going to see that shift. We've talked about the millennials, but within the next couple of years, the millennials will represent over 50% of the cash flowing into investments. And just as they're going to affect politicians and who they vote for, they're going to also vote with their money into these companies, and so companies that don't have a good ESG score. And so the only thing in my mind that's left that hasn't been addressed is how we address carbon intensity in the commodities market. And that's where we need to get into carbon attributes, not carbon pricing, where every carbon molecule that trades through the supply chain has an attribution to the intensity in carbon it contributes on its way. And that in itself will then drive the commodities market towards lower carbon.
And is that something you're working on at the moment? And Greg, come in there, and Jason, yeah.
Yeah, I mean, we've already seen the first, what we call responsible gas being sold in the US by measuring the carbon intensity from well to the power company. The power company was willing to pay a premium, which was a 5% premium. That's unusual. I mean, but was willing to pay a premium because they could demonstrate that the carbon they were putting into their assets was the lowest carbon intensity. So you can already see how quickly that market could evolve. And if everyone starts doing that, maybe if regulation says your carbon going into your plant has to have a certain carbon intensity, that will then drive the value of carbon and will drive the outcome that we're looking for.
And we heard an example too, just this week from Meg from Tellurian talking about that they paid a premium also to make sure something that they weren't regulated to do, but they actually, as a responsible company investor, did it.
And if you can measure it, you can put a value on it, which then will also
and I
drive
think this
value
is,
to the company.
great example to see. Greg, please.
So I think one thing that it's tangential, but I think it made me feel like it's related. Standardization and clarity will help also move a lot of things forward. Like in the green bond market, it's the sustainable development bond market. There's a lot of different governing bodies right now, and everyone is sort of working through what does it mean to actually have a green compliant or social development goal compliant financial instrument or to finance these projects. And I think the faster we move to a point where there is some sort of general accepted practices that are less poorly defined, I think will help facilitate those markets becoming deeper and more capital flowing. Like there's a lot of work being done. Like Invesco, PIMCO we've launched a climate fund. We're looking at ESG-related ETFs as well as other mandates that we've been doing. And we're looking at potentially launching an impact fund, for example. But when we think about all these, still there's a lot of definitional challenges when you want to have a uniform conversation. That's inevitable, but the further we get along on defining what these terms are on a universal basis, I think the more developed and capital markets could become.
Jason, you wanted to come in early on that, please. Jason Bordoff, yes.
I was just responding to your question about regulation, which I guess my view is a little different from Chris's. Pollution is the quintessential market failure in the study of economics. When you undertake some activity and put carbon in the air, pollution in the river, secondhand smoke in the air, your activity is harming someone else. You don't internalize the cost of that. Markets don't solve market failures. That's why they're called market failures. And so the role of regulation is to internalize those costs. So when I look back on environmental problems we've had throughout history, whether it's acid rain or the pesticide DDT, or lead in gasoline, and on and on and on, those were not solved because of voluntary market solutions. Those were solved because of smart, cost-effective government regulation. There is poorly designed, ineffective government regulation, so we can have an argument about what kind of regulation there should be. But this doesn't get solved without that, I don't think. And I think climate change it's especially true for climate change because there's such a poor understanding about where emissions even come from, the scope of economic activity in our everyday lives, the fact that carbon emissions result in like the nooks and crannies of our economy people don't even know about. We focus on renewables in the power sector, we focus on electric cars, add up electricity and vehicles, and that's less than half of carbon emissions. So you really do need some sort of economy-wide regulation. It could be carbon price, it could be something else. We're here with Congressman Curbelo, who introduced carbon tax legislation in the US Congress. Something like that is needed, I think, in order to really make the kind of progress we need.
But you do show examples which tend to be more specification. So lead was an example. You set a specification. We've done it in gasoline, sulfur. John talked about IMO. Set a specification. Let the market then solve it. And I think that's the piece that we think we can't do that with carbon. You can. Why doesn't gasoline have a carbon intensity spec?
Right,
and I think what's changed and why we can do it today is that we have so much data and we can measure it, which we couldn't have done 2 years ago. And I think understanding that possibility, I think changes the way the regulator will interact with the market.
Now, I see a few of you on your phone. I know you're absolutely intrigued with our app. So stay with us because we're going to get a little interactivity going here and we'll get one of our poll questions up here. So stay on those phones and go to our interactivity space here and just let's have a quick look here. So when you think about ESG standards and how you generate your business, I mean, how do you respond? It should be actually just 1, 2, 3. It makes sense, carries on with the no-brainer bit. But so, you know, how you operate and, you know, generate business. What do you think? No way? No choice? Or actually no-brainer? It does make sense. So 3 and 4 go together in that one. And I've given no phone access to our panel just to keep them focused. Sorry about that, guys.
I don't know.
How you more operate your business, generate probably isn't the word. So it makes sense here. So this is I think we're talking to the converted here when we're looking at particularly this audience and, you know, looking about, you know, ESG standards and what we need to do. Jason Bloom, when we look at, you know, ESG standards in terms of scoring, it's not really distributed equally. Break it down for me, will you?
Yeah, well, especially in this environment and the topic we're addressing today, carbon emissions, greenhouse gas emissions tend to get most of the headlines. But if you look at a standard equity scoring model that's pretty pervasive, and people will tweak it, but 15% weight to carbon emissions, 36% weight to governance. The environmental score may be half, but you know, only 15% of the 50% is weighted towards carbon emissions. Then you've got pollution, right? Pollution, toxic waste gets just as high of a weighting in a standard ESG screen. So I think it's just good to kind of keep the issues in perspective. So you look at a big diversified energy company, ExxonMobil, for example, they're in one of our ESG, broad market ESG portfolios, and we've had a few clients call in and going, why is ExxonMobil in an S&P 500 ESG portfolio? And we're like, they actually score in the top top half of all S&P 500 companies. You're like, how can an oil company do that? Well, one, as I mentioned, that it's not all about greenhouse gas emissions, but two is they have an excellent organizational structure score. They are very conscious of all the risks they have to manage, and they have multiple programs across multiple geographies that are very highly focused with a good track record of addressing those risks. So they're operating well. Even though they're in the oil and gas sector, they're actually score better than half of the S&P 500 companies. Now, when you talk about risk in the portfolio, for energy companies, environmental risks tend to have more of a financial impact. When you look at financials, for example, the environmental score is not nearly as important as the governance score if you think of a bank and the way they run their business and compliance and things like that. But I think it just helps to put some perspective in that, one, that oil and gas isn't bad in the ESG framework within which we invest, and also that it's really more about picking best in class. So when you look at what Meg did to that oil field yesterday, where she was talking about all the enhancements they made to reduce carbon emissions, that's something as an investor where we're going to be loaning money to energy companies. They're going to have a better chance of us investing in their debt or granting them a loan than the company that they bought that from, right? And that's kind of what it comes down to.
John, you want to come in? And Chris after.
Just was going to make the point that there remains a pretty significant information asymmetry between the public markets and the private markets when it comes, well, to many things, but for the focus of this conversation, to ESG information in the scoring sense and in the rating sense. There are some companies, I know S&P does a lot of public market ratings when it comes to ESG now, maybe less focus on the private markets. There are some companies that have tried to do private market ESG ratings, but they tend to do it based on a methodology that's like scraping media reports, and that can be really, I would say, hit and miss in terms of accuracy and how informative it is for investors. And the regs so far really have focused on the public markets, on the exchanges. So for investors who are concerned about this stuff, you pretty much got to go directly to the firm and ask for information from them. You don't have as many alternatives as you do in the public markets.
So, Chris, I mean, when we look at this too, do any of you think, is it a flawed system? Should it be better? Could it be better? But please, your contribution on this.
Well, I think any rating requires disclosure, and companies are not willing to disclose, therefore should get a default poor rating. But the problem there is also that you can have your company rated, and I think we talked about divestments. You look at the North Sea, companies with strong ESG ratings are divesting those assets because they're coming to end of life. And they're now being cash cowed by putting those to private equity who don't have to disclose. And this is why...
And there's no lack of buyers.
And there's no lack of buyers for them.
Yes.
So, people worry about cash. No, there's no lack of buyers. And, this is why I think, the commodities market has to put then carbon price, because that would then hurt them. Otherwise, they can come in and they can irresponsibly exhaust those assets. I did, if I'm allowed, I know you don't allow us to ask questions, but I think, because your points around ESG was absolutely spot on. The carbon part is such a small part of the scoring. But there is obviously the TCFD, which we heard in the previous presentation. And I'm just interested, what impact that has and how TCFD plays in from an investor perspective when you're looking and comparing with ESG.
What do you say, Jason? Yeah.
The TCFD?
Yeah, Task Force for Climate Financial Disclosure.
Oh, well, like I said, it all comes down to, and so I'm talking about some standardized ESG scoring models. Of course, then we do our own research and we add whatever we can to that. So one is it helps with the private issue, because if we're negotiating on a debt offering, we're gonna ask that private company to provide the data that they aren't publicly required to provide. So there's a little bit of help on the way there. But I would say that it all comes down to whether that company's behavior with respect to those issues is raising a financial concern, and it's going to be on an individual basis, especially when you're investing as an institutional debt investor. You have an opportunity to have a dialogue with your client, and your client is in the debt markets is back in the market on a regular basis, needing refinancing, needing to roll that debt. I mean, just the top 20 oil majors are going to be rolling $60 billion on average, give or take a year, for the next 5 years. Just in the U.S., the energy industry will be rolling that much debt every year. But those big companies aren't in the market for an equity offering on a regular basis. So as you're an equity investor, I don't think you have, at the moment, maybe quite as much opportunity to impact what those companies are doing. But as a debt investor, you can press change a little more quickly.
Now, we have about 20 minutes left, so we have plenty of time to ask some questions from our panel. You can, of course, just let me know you're here, or put them on the app, whichever suits you. And we have one question over here. I'll come over to you right now, I think is the best time, because I have one mic on this side, but don't worry, we'll get you this one here. A lot of, as I say, great expertise from these people, so I would take advantage of it at this point. There you are, sir.
Yes, thank you. My name is Veli-Pekka Tynkkönen and I come from the University of Helsinki from Finland. I follow Russian energy policy and especially the emissions from Russian oil and gas production. Methane is a big issue. So a question maybe to Chris on this the developments during the last couple of years. You mentioned about measuring, for example, methane emissions in traditional gas production. For example, these countries like Russia, which do not provide this knowledge data, how can we get there and know better?
I think everyone always says yes. People don't. If people have got bad performing wells, they're not going to measure it. It's very simple. You give them a default carbon attribute, which is a very high carbon intensity. So it says if you can't measure it, auditably and understand it, you're going to get the highest level. That means when you're then selling that gas, you're selling it and having to buy a very expensive attribute to offset. That then incentivizes the market to do it. And I think that's what we're seeing, and I'm quite excited about what's happening in North America, is we're starting to see people, not only are the consumers demanding to know the end-to-end and have it auditable. So that's working, but I think as you then bring it into a actual attribute, which is sold with the commodity, you now drive towards the incentivization to do it, and you get penalized if you don't. And that has no borders. You know, it's not about the carbon pricing, and which has borders and allowances. It is purely associated with the end-to-end supply chain, and you can measure it all.
And I guess in every country we'll see different, expectations. Sorry, go ahead, Jason.
I was just going to say, we're also going to know, because we're going to soon have satellite data from a variety of initiatives, including NGO initiatives like Methane Sat from the Environmental Defense Fund, that's going to spotlight where the problem spots are, whether people report or not. We're going to know.
But you need a price then to drive the action.
Absolutely. Yeah, absolutely.
We have another question here, sir. Tell us who you are. Just.
Thank you. Daniel Lipton from Critical Resource. Just a question, this is a theme that I think a lot of you have alluded to, which is around perceptions, certainly among companies that are being rated by ESG rating agencies, that those ratings of data is flawed in some way, that it's incomplete, that it's based too much on publicly available information like media sweeps, that it's sometimes based too much on what the companies are disclosing, and there's not enough scrutiny. And I do wonder whether, amid the very, very welcome growth in ESG investing, I think it's what the world is crying out for, that the Achilles heel of that growth, and might lead to a sort of the bubble being pricked a little bit in the future, is the inadequacy of much ESG data, because it is, at least from the experience of my firm, it's often done at a relatively junior level by analysts rather quickly. So a company which has a lot of very, very complex impacts on a whole range of issues, it's very difficult to distill that quickly and simply. And also, of course, I'll perhaps stop there, but also, of course, what people mean by, everyone agrees that ESG is good, but what people think are important issues, or the most important issue within the whole range of ESG topics, will vary hugely. So there's a lot of subjectivity in there. Just interested in comments. Could this be an Achilles heel for the growth of ESG?
Thank you.
Well, I'll give just
John,
brief,
start.
yeah, just a couple quick thoughts. I do agree that. Oh, sorry. That we'd
No,
like.
Jason, go with it.
Did you get me right? Okay, sorry. The data could be better. A lot of progress is being made. Our goal would be to have something like would be that ESG data needs to be reported with the same standards as they report financial information, and it should be audited as well. And that would be the ideal world. And I think that we are pushing towards that. It's hard to say when we would get there, but it's also difficult if you want. A lot of times you want to do back testing and historical research, and this data really didn't exist in decades prior in any way that you could find it. And so it is a very new, rapidly evolving landscape.
Chris, Greg, go ahead, and then I'll bring Chris in on this. Greg, go for it.
I would just point out that it's in the advantage of industries to, I think, disclose more, in part because if they don't, you probably increase the likelihood of investors going to exclusionary investment approaches, where instead of being able to find the best of class, they go to exclude the entire class. And I think that's something that we have seen a growth in the last couple years. In ways before we were always sort of trying to evaluate the companies based on a variety of metrics, of which ESG was a part of, and you always had to take if you wanted to be good stewards of capital, that was an incredibly important starting point. But now if you're getting to the point where the investors are saying, I will not invest in more than just coal, firearms, and tobacco, I'm going to add oil and gas upstream. And that is a conversation that's happening. Now granted, there's a group of investors that are saying, well, we're still going to keep that investment, but we're going to dedicate a portion of our capital to ESG specific and sort of like create a balanced portfolio. I think that you're seeing some of that, but the exclusionary stuff is going to increase with the less quality data, the greater questions around it. And that's where I argue that's accountability, credibility, and standards are in the interest of everyone.
Yeah.
Okay, Chris, come in here and then we'll go to the question, but go ahead on that topic, please.
Yeah, I mean, I think as a rating company, need to make sure to respond to that, and the fact that, I mean, many will know after the financial crisis of 2008, the ratings companies got fined a lot of money for getting, things wrong and not seeing this. So there's certainly not junior people put on it. The key thing with any rating or any price assessment is that you have a clear and transparent process. And what you're measuring, I think, comes to Greg's point. You're measuring the relative performance. Yes, you're right, you don't have all the data, but does that stop you doing a rating? No, you have to then say, this is the methodology, this is what data you use, and this is how you get to the outcome. And that at least enables people to make more informed decisions rather than not provide the information at all. We'd all love to have lots of the data. Disclosure may be somewhere where I think potentially regulation can help. And that's why I asked about the TCFD, because the methodology of there is so prescriptive, at least you are forced to disclose standard stuff by all companies, which you can compare closely to like for like.
And that issue is addressed in a way in that ESG scoring models that we use, and it's broadly common, is that if they don't disclose adequately, it's marked against them.
Yeah.
But these are all voluntary disclosures as well. They're becoming standard, I think, standard accepted in the industry.
It's
Expected?
I mean, a lot of it is, a lot of financial disclosure is required. Ultimately, it may be voluntary, but if you're going to get a bad rating, that's not it's not a voluntary outcome of getting a bad rating. Yeah.
John, I'd like you to take the question that's come up here. Investors are not asking about climate change and risk in quarterly earnings calls due to the firewalls within their firms. It's on the small screen there, but it is rather small, such that ESG screeners are not the ones meeting with the CFOs and the IR teams on a quarterly basis. So how do we change that? How do we improve that dialogue? Or you're looking a little mystified there, maybe who wrote it can
probably my own limitation. I'm not sure I totally understand the question. Oh, well,
I think the right people are not talking to each other.
All right, so I guess maybe I'm thrown off by the quarterly earnings calls, which we as a private market investor don't do. Some of our companies, and we're a private equity firm that's also not a public company, so we don't do quarterly earnings calls.
Right.
We do, meetings with
For
our
the people that,
investors periodically. I don't know. I guess I've found that the level of interest and level of seniority, both people who are asking the questions on the part of the investors and people who are answering them at a firm like ours, has increased. I mean, just to give one anecdotal example that's more analogous to how we operate. So we have what's called a limited partner advisory committee. So the sort of senior most of our investors that we meet with quarterly. And ESG is now a regular part of those conversations, either presented by our CEO or sometimes by people who work day in, day out on ESG issues. But that was not the case 3 and 4 years ago. It is the case now because there was interest on the part of our investors in having that be a part of the meeting.
I would also
Greg,
I kind of almost push back on that because I feel like I've been perceiving a pretty big change in that, as you were suggesting, how it's become a unified approach. And a perfect example is I don't think any E&P company can get away in a quarterly call right now if you're US based without discussing your exposure to a fracking ban on federal lands. Like that's a governance, that's a whole part of this issue that I think is coming together. I think they are hitting it on as much as a nail on the head. And if you look at utility companies, their carbon considerations, I mean, I think this has been elevated beyond the, the ideologue in the back corner office that isn't talking to anybody else to something that's like central to an investment process.
So you're
and you're being demanded to.
Happening. Yeah.
And you're being demanded to by your own clients. So in pension funds, endowments, you name it, everyone's asking what you're doing in this space.
Yeah.
Okay, we have a few more questions. We have time. Do you want to come in?
It's just starting. Greg is spot on. Like we're in the midst of this transformation. So that comment could have been accurate at a recent point in the past, but I don't think it's the case now, right? And somebody had been meeting with shale companies, and they came back and said, well, they're not hearing much about ESG. This was last year. And I said, they will. They will next year.
Yes. Please go ahead, sir. Let us know who you are.
Paul Jackson from Invesco, so I'll be gentle with you, Jason.
Thanks, Paul.
Actually, just in terms of the last question, I would say one way of putting more emphasis on ESG issues is for companies to get away from quarterly reporting cycles. They spend way too much time on this quarterly process and dealing with financials on that cycle. Ditch that, get away from it, and then you could spend more time worrying about the things that we're talking about. As somebody who's been expecting these sorts of issues to become more important, really since the 1980s, when I first became aware of green investing, I've got to say I'm a little bit skeptical about the recent rise in popularity, and it feels a little bit like a box-ticking exercise in many ways. But I guess my question to you as individuals would be, either in your personal life or in your professional life, have you actually divested based on these issues?
So I think that's exactly the right question, and the concept of materiality is really important here. Both materiality in terms of, from the perspective of a firm like mine, are we taking into account ESG factors in a material sense when we're making investment decisions? And then from the perspective of people who invest in our firm, are they taking the answers to our questions on ESG into account in a material sense when they decide whether to invest in our firm or not? I think the evidence on that score, you're probably right to be somewhat skeptical of it. We get asked this question all the time by our investors. Have you ever foreclosed an investment or avoided an investment entirely on ESG grounds? We have an answer to this question, which is basically that we never make an investment decision based entirely on one factor or another factor. It's always comprehensive, but ESG factors have in many cases played a role in a decision not to make an investment. It doesn't tend to be a satisfying answer, but it's the best we have.
Greg, what do you think?
I'm just imagining investing in coastal real estate in southern Florida right now. And you're buying something, an asset that has a 30-year life, or I'm going to invest in a plant. Like we're building, we're as part of one of the firms that are up here, we're on the board and shareholders of, we're building a 26-foot, wall to shield our assets in Louisiana. Like, this is part of the cost structure of that project. It is literally a part of the entire investment decision. So, like, whether or not you're getting to the point where I'm saying I'm going to completely divest of my oil and gas companies in my portfolio, that's very extreme. But on a daily investment decision basis, if you are ignoring these factors, whether they be governance, whether they be political risk related to environmental, whether they be, environmental risk, such as I'm building a building adjacent to wildlands that have fire prone in California, something we're very familiar with in California. Like, you have to be embedding those risks better. I don't think the market has done a great job in that in the past. You can see that in the sort of return in some of the insurance-linked securities, but I think we're going to change. And I think we have no choice because of the way in which the climate is changing and evolving.
Okay, we really want to be wrapping this up soon, so I'll let you quickly comment on this, but give it back to me.
That's taking it from a slightly different angle. Rather than trying to change the behavior of companies and other actors so that we don't get environmental problems, it is basically saying, okay, I'm going to let them do all of that stuff, and I'm going to make sure I don't buy any of the stuff that's going to be damaged by what they're doing.
Or I'm going to price the risk properly. But you have to change the cost of capital for anyone who's in those danger zones, in a very tangential example.
If I can maybe ask you all on this one in terms of where all this goes for the oil and gas sector at the moment, and when we look at perhaps policy changes that are happening, maybe this is all about pulling back from the oil and gas sector. We're hearing over the past few days that people are worried about the perception of this industry. Lots of people are stopping in terms of investing in fossil fuel. Jason, perhaps, is there a danger of underinvestment in this sector? And then what trouble are we in? Because we're within the transition and that investment has to keep going, despite the fact we're all heading to a new, cleaner, greener future, but we have to keep almost a dual investment path going at the same time.
Yeah, I think that's that's an important question following on the one we just heard, because I think, Greg, when you mentioned sort of people are being asked about a fracking ban or what climate impacts would do, and that's risk assessment, which is important, either of climate policy or of climate impacts. A lot of the ESG pressure is saying, well, even if we don't have that policy change, we want to force change in the energy mix by pressuring companies to operate differently based on how we deploy capital. And there, I think, is where Etna's question comes up, because there is a disconnect, huge gap between the level of ambition and the reality. of what policy looks like now and how quickly this energy transition is coming about. So I think there's a meaningful chance that as this pressure builds, and imagine if we see slower oil demand growth, imagine if oil demand were flat year on year for 2 or 3 years in a row. Suddenly the headlines would be peak oil has arrived, capital would pull back in a meaningful way because the transition has begun, despite the fact that you have 5 million barrels a day of annual decline, you need continued investment just to stay in place. And this is not going to be a predictable and linear transition. It's going to be a messy one to the extent it's happening at all. And so the possibility of underinvestment that actually leads to tight markets and price spikes, I think, is real. And in a sense, that's part of the strategy of the campaign, because the idea is when that happened, that would force people to transition toward alternatives even more quickly in response to those price spikes.
I want you all to comment on this. So John, Greg, whoever it's John, if you want to come on this, but all of you, please.
Can I just add one thing? I agree with Jason
2 minutes
100%, except for one small difference. I don't think you have to wait to 2 or 3 years of flat demand growth. I think that right now, if you're looking to invest in an asset that has a 10, 15-year, or 20-year investment profile, and the ESG concerns are creating a greater potential path for demands. We've talked about it a few days ago. Are we 65 million barrels a day in 2040? Or are we 110? That is, even if you do think that we're potentially going to have rising costs because technology on the supply side, you can create some arguments where you can think prices will stay elevated. That is, it's going to scare investors who are going to be concerned about the future trajectory of demand. The conversation has changed, even without getting to the point where we've hit that peak demand or we've hit no growth in demand growth yet. I think that's a big part of what's changing in the capital markets.
So I guess I would also say I agree with Jason with a caveat, which is I think it's a bit of a false choice right now for people who purport to be making decisions based on ESG factors when it comes to oil and gas, in large part because returns have not been great in the public markets and in the private markets. And so in a situation where returns are kind of back with a vengeance, I think it becomes a much more complicated choice for investors as to whether they'll be as principled as they purport to be right now.
Sure.
John, why am I calling you John? I've decided to rename you. Jason, please.
Yes. There's this, I think, bizarre paradigm in the market where you're blaming the oil and gas producers for the consumption of oil and gas. The easy fix here is to work on the consumers, to shift their behavior, and the supply will follow, right? I mean, if you look at the largest growth in carbon emissions is occurring in things like transportation and consumer goods, shipping their goods. Well, those companies have choices that they can make in the way they ship their goods. Why are the oil and gas companies getting all the blame? They're buying it.
Yeah, and I think we saw that Fatty clearly gave us those figures on the EVs versus the SUVs. Very, very clear figures. I'm leaving you with the closing word on this one. Chris.
I think we heard last night in the Excellent Night Owl session that the activists want us dead and perhaps, or the industry dead, and perhaps the industry want the activists dead. Actually, I think we all know we've got to work together to find some solutions. But we also know that society in general is driven by money, and companies are driven by money. And so the first thing for companies is to create markets which drive the outcome for us. That's why I would argue for carbon attributes, but also that ultimately we all want to get returns. And what we heard from the previous saying the industry is not generating returns. We shouldn't forget that 20% of the UK's pension revenue comes from BP and Shell. So let's not forget. I mean, this is going to be driven by money and the way in which we make the markets as efficient as possible to get to a shared outcome.
Thank you so much for your insight. We have to wrap it up there. I mean, just a lot to share. We could indeed, I think, go for another hour on this one, but we have to wrap it up. You will have an opportunity to have a conversation here, I'm sure, if you want, with Greg, John, Jason, thank you very much, and Chris. Thank you all so much for being with us, and thank you for your contribution. Thank you for sharing your expertise. So from all of us, we're most grateful. So a lot of debate still, I think, in that space. Do stay with us. We have still a very, very busy program. And once again, I'm